Just enjoying a nice coffee from Starbucks. Just to let you know, I was joking. Little parlor trick there. It actually isn't Starbucks. I know you can't see it. It was just a bottle of water that I drank. Could have really drank nothing and it still would have had the same effect. But Starbucks reported some earnings, baby. And guess what? You know what? They did a good time. Look at this. Shares up 2.8% after hours. I'm just going to call it 3% because it might as well be 3%. Let's dig into it. See what's going right for them and see what we like on it. We're going to be going through our usual couple little news points as well as their press release on their website, their investor relations page. But EPS in line, both on a GAAP and non-GAAP basis. That's good. Gotta love when you get in line. You don't want any losses. Revenue up 7.1% year over year. Beats by 70 million. So again, definitely not a major beat, but it is a little bit of a beat, and we'll take it. I love a nice beat on revenue. Big news too. They decided my baby Starbucks increased dividend 13.9% to 41 cents per share. That's freaking lovely. You know I love dividends. And I'm really talking about Starbucks because guess what? I love Starbucks. I love their stock, at least. I don't get Starbucks much, but because I am not a basic lady. I'm going to say that. Okay, no, just kidding. I was just kidding. It's just a joke. I'm making a joke. Okay, Starbucks, they're good. They're good stuff. I just don't drink coffee. I'm sorry. You know what? I love talking about dividends. Not only do I own the stock, but guess what? You know it. I love dividends. So that's why I want to talk about Starbucks here and their earnings. Starbucks at 3% on strong global comps. Jumps after hours trading. Comparable sales show strength in the second quarter in a row. That's right. Global comp sales rose 5%. Ooh, top 3.9%. Consensus estimate. Average ticket was up 3%, and transaction growth was 2%. Gotta love it. We grow more transactions, and the price goes up. Hey, I love it. Global comp sales were up 6% for the Americas and U.S., while international comp sales rose 3%. Again, very good growth for U.S., Americas and U.S. Not bad. Active membership in Starbucks Reward increased 15%. Gotta love it. That Starbucks rewards people. It gets people more, into the store more often. That's exactly what we're looking for. So that's pretty exciting. You gotta love those rewards programs that get people more involved because that gets people coming into your business more. The company's consolidated operating margin fell 90 basis points to 17.6% versus 17.1% consensus. So operating margins did fall, but they did beat consensus, which is good. I gotta love it. I love margins. We'll talk about that. Opened 630 net new stores in quarter three. Take its store count to 31,256 at the end of the quarter. Gotta love it. Starbucks expect fiscal year comp sales growth of 3 to 4%. That's not awful. EPS of $3 to $3.05. And this is for the full year, by the way. It's fiscal year 20, so anticipated, which is a little bit lower than consensus, actually. So, again, I think it was just such a good quarter that you see it up. Sometimes when you miss consensus on an earnings per share basis, in terms of your forecast, occasionally the stock will go down. Again, earnings are a tricky situation. You just never know with things. We're going to go into their press release, see what they have going on. It's shifted all the way to the right. Love it, Starbucks. Love your website. Comp sales, 5%, 6% comp sales in the U.S. Global net store growth, 7% versus prior year. I love it. 70% net store growth in China. More China. More growth in China. I love it. We just want to globalize Starbucks, get as many people in there as possible. EPS up 13% year over year. Starbucks rewards members up 15%. Returned $12 billion to shareholders, announcing a 14% increase in dividends. Yeah. Fiscal 2020 outlook, reaffirming long-term operating growth model. That's right, Starbucks, you're growing, baby. I gotta love it. So here is just words from President and CEO Kevin Johnson, probably the most basic white guy name I've ever heard in my life. I'm very pleased with our strong finish to fiscal 2019 as we sustain positive momentum across each of our business segments. That's what he talks like, I'm guessing. He doesn't talk like that in case you've heard a conference call, but our U.S. business delivered 6% comp sales growth in the fourth quarter, while China grew 5%. Total transactions by 13%, which you'd expect if they're growing 17% in terms of store count. You'd expect a little bit higher than that, actually, but it's okay. It's good growth. Strong performance throughout 2019 gives us confidence in a robust operating outlook for fiscal year 2020. Making meaningful progress against our strategic priorities while streamlining the company, bringing our more focus and discipline to everything we do. Investments we are making long term in our partners, our store, beverage innovation, and digital are collectively delivering elevated Starbucks experience as evidenced by all-time high customer connection score in the fourth quarter. You gotta love it. People love it. People love talking about Starbucks. This long-term focus is instrumental in how we build. Again, in terms of this digital that he speaks of, I think Starbucks does have a long way to go in terms of their technological improvements. Again, I think obviously it's nice to have your little barista there to say your order about, but again, they're going to get to a point where a lot of that self-service ordering, where you're not speaking to a physical person, where you can have like one of those McDonald's customizable menus. That's really the future of Starbucks. They're going to be in most stores. They're not quite there yet, but once they are, I think it'll be pretty exciting to see how that goes. Global comp sales, again, 5%, 3% average ticket, 2% global comparable transactions. I love it. Let's see. What else do we want to look at here? Company opened 630 stores. I love it. Consolidated net revenues 6.7 billion, grew 7% year over year. You know it. GAAP operating margin. Yeah, that's all. That's not awful. I mean, a little bit there. Company returned 2.7 billion. We care about some highlights here. The store growth, gotta love it. Consolidated net revenues 26.5 billion for the year, which is 7% growth year over year. Operating margin fell a little bit, which, it's not unexpected. Earnings per share actually down year over year for the full year, but they're expected to grow that next year. And the company returned $12 billion to shareholders through share repurchases and dividends. And obviously they plan on increasing that with an increase in dividend. So obviously there's some resegmentation between China, Asia Pacific, Europe, Middle East, Africa, EMEA segment have combined into one international segment. So now they're reporting it as international as opposed to the two different segments from China, Asia Pacific, and EMEA. Nothing absurd there. Definitely nothing absurd. To better support review of its results, the company changed the classification of certain costs. The classification of company-operated store occupancy costs from cost of sales to store operating expense. Okay, so that way when you're looking at that, you know what you're looking at. That's what we care about. Net revenues from Americas grew 9%. Gotta love it. Good, very good. I mean, if you're looking, very good growth in terms of Americas here. Comp sales 6%. And transaction and ticket price up 3% as well. Store count increased 3%. Revenues up 9%, and operating income up 5%. So, again, very good numbers in terms of the America segment. Not that they're definitely not bad numbers in terms of the quote-unquote international, and this is everything combined now. Obviously, a lot of the store growth and operating income growth is going to be through growth in China. That's really kind of where they're trying to focus their their growth at this point. So nothing absurd here. In terms of this, good guidance. They're going to add approximately 2,000 net stores globally. Sales growth of 3 to 4%. They want to grow about 600 net new stores in the U.S. and 1,400 international. Mid-teens growth in China, again, like they did this past quarter with 14% growth in stores. They want to see that same growth in stores in China again. They want to keep busting out those. There's not that many Starbucks in China, so they're going to keep increasing the amount. They want to utilize that market because there's so many people there. It's such a densely populated area. There's a lot of room for business there. Capital expenditures approximately $1.8 billion, as you see there. Nothing absurd. Company updates, you gotta love it. First Starbucks Now store in Beijing in July. New Express store format integrates Starbucks store environment with the company mobile order and pay technology. Starbucks delivers in one seamless and convenient experience for customers. I love it. In September, Starbucks hosted 12,000 store managers and field operator leaders at its largest leadership experience. 3-day conference held in Chicago designed to help strengthen leadership and capabilities and solidify the foundation of an enduring company. Gotta love it. You need your leadership to be right if you plan on growing. Starbucks welcomed 3 new appointees to its board of directors. Dick Allison, that's what I'm going to call him. Dick Allison Jr., that is. CEO of Domino's, Andrew Champion. Look at that. Who is the Andrew Champion is the executive vice president and chief financial officer of Nike, and Isabel Gemahi, Apple's vice president and managing director of Greater China. That's right. 3 appointees. Company repurchased 23.5 million shares of common stock in Q4. And then 29.2 million remain available for purchase under the current authorization. So they're not even halfway through their share buyback program. Again, as I mention all the time, less shares outstanding. The company purchases more shares means less shares outstanding. It means every share is technically worth more value. So again, I gotta love it. I do enjoy that conference call. I haven't listened to the conference call yet. I certainly will. Forward-looking statements. Again, we really talked about guidance and everything. What I want to look at here, as you know I want to look at it. Let's scroll down, and I want to see. Show me the good stuff. Show me the good stuff. You know what I'm looking for already. Show me your cash. Show me that cash money, baby. Show me that cash money. Hoo-hoo, here we go. Cash money, baby. Let's see. Cash and cash equivalents. And this is recorded in millions. So, you can see a sharp decrease in terms of their cash between previous year at this time and this time. So, $2.6 billion in cash, where last year they had $8.7 billion in cash. So I'm going to look for some justification for that. There's probably got to be something. Look at this major decrease in terms of assets year over year. Again, I think a lot of that's just due to expansion. They're really using that in terms of expansion. Their total assets down around $5 million year over year, or $5 billion. It's not insignificant, but I think there's justification for it. And I also want to look at long-term debt, which they did increase debt. So now they have $2 billion in terms of cash versus $11 billion in terms of $11 billion in terms of debt. So obviously that ratio isn't fantastic, but they're a company that can make up for that and account for that within a year if they really wanted to, a year or two. They can certainly pay off all that debt. I think really that debt, again, is just a revitalizing of that business. They're working on expansion pretty rapidly in terms of technology, as well as just increasing the store count and focusing their marketing efforts a little bit differently than they did in the past. So I think that's nothing absurd. is Starbucks worth a buy? I mean, let's just give a little estimation here. I mean, we'll just look, 1 month stock's beaten up, but we really care about year to date. That's what I've been really chasing things on. Year to date, stock's up massively, 30%. Stock's up massively, 30% is pretty high. Currently rocking a PE ratio right around 30. Again, I think the valuation for the stock at this point is a little bit high. I love the dividend of this company. The yield is a little bit low, and that's simply just due to how high the price of the stock is right now. Again, this PE ratio could certainly go down as they see growth next year, as they plan at least, in terms of EPS. We'll see. We'll see how that goes. I think the valuation isn't necessarily justifiable to purchase more shares, so I'm kind of in the hold category on this stock right now. I do like the way that they're going with the business, but I do think it is currently in a hold status. Certainly not a company I would sell. I do think I would not pick up shares right now, though. I would certainly work on holding and just enjoying that dividend for the meantime. If the stock goes down, I would see a buy-in point. Well, where would I want to buy this? I'd buy some more shares if this was priced around $70. I would. I think I'll adjust that expectation potentially, but I think I would wait until around $70 to buy more of this stock. But so far, I'm okay with my position, so I'm not, too hurt if it's not going to be at that valuation anytime soon. So I'll do some more analysis, see where I might want to pick this up. But right now, my initial estimates, I would probably pay for it around $70. That PE ratio would be a lot more manageable at that point. And if they continue growth through the next quarter, I'd love to see that as well. So that's all I got for you in terms of Starbucks here. Hope you enjoy a nice vanilla frappuccino on your way out. Whatever you like. I don't know. I don't get Starbucks.